Hey, Simple Passive Cash Flow listeners. Today I've got Michael Flight on the line. For those of you who don't know, Michael has an extensive background in commercial real estate investing. Is a principal in Concordia Realty, and they specialize in shopping plazas and retail properties. So think of those little strip malls with the grocery store, and not the big ones, the shopping malls with Macy's and Nordstrom. Um, and it's something that I've been turned on to lately, and I thought we'd bring him on, and since he's the expert in this. And let's get to know Michael a little bit better. You started in this way back in the 1990s. Take us back to that time when you were kind of getting started in real estate. What was your first step into investing?
Well, Lane, I actually started in the 1980s. So my first step into real estate is my
I didn't want to date you that bad.
That's all right. That's all right. We started our company in 1990. But no, my first step into real estate is my older brother, Jeff, and I decided that for whatever reason, we went to a nothing down seminar. And because I think we wanted to get rich. I was still in college, and he was just out of college working a straight commission job. And we went to this nothing down seminar, and it really, we figured out very soon that you needed a regular job, and you needed other things to qualify for a loan. And so the nothing down thing didn't work. But I was bitten by the bug. I had gotten a job with a apartment investor, and we were redoing apartment buildings in the Chicago area. And then he said to me when I was graduating from college, he said, I really can't do a tremendous amount more for you. What I would recommend is you go into commercial real estate. And so whether it was brilliance or laziness, I decided to go into retail real estate, because if you got a tenant, you could potentially do 5 to 20 deals with a tenant at a time versus knocking on a lot of doors for an office tenant or an industrial tenant, and you just do one deal and then you have to go out and get another one. So I look at it as intelligence, but it's also a lot of laziness. I didn't want to go out and continually cold call for tenants.
So that first job with the apartment guys, were they doing like Class B and C at little value add and then sell it in 5 years, 7 years? Or?
They were really buy and hold, and what they would do is buy Class B or C in Chicago neighborhoods or the inner ring suburbs of Chicago, and they would redo one apartment at a time. So as the apartments turned over, they would go in and do an extensive remodel, and they do some, remodel. Their first thing to do would be to put in a laundry room and stuff like that. And these were, like I say, inner city stuff. They weren't suburban garden style apartment buildings. They were probably
they didn't have those back then, did they?
Oh, they did. But, in the city, it's, they were like 32 to 64 units, just packed in, and a lot of studios and one bedrooms. So, and we would go in and completely gut a place, or, just put a smooth coat of plaster on, redo the floors, and redo the kitchen, that type of thing. And then, he wouldn't go in and do an extensive remodel on a lot of them. It was just, as the things turned over, that's when he would, go in and redo it. So I got to breathe a lot of asbestos when I was younger. So it probably took a few years off my life.
Yeah. So when you did you finish college, and did you ever do a regular day job for a while?
No, I finished college and went straight into straight commission real estate commercial brokerage. So, because my mother, my father passed away when I was a senior in college. So my mother was really worried about, having money. So she said, you got to start paying rent right away. And so I was not only doing the real estate retail brokerage, but I also had a nighttime job delivering Domino's pizzas. So,
but you went into that brokerage job kind of knowing that, you saw what these other guys were doing with the apartments, and did you kind of knew you were going to do the same thing with shopping centers at the time, or was it just get into the industry?
I don't know if I wanted to get into the real estate industry. I think at the time, the real glamour job was, the big office towers. And in the 1980s, they were building huge office towers. So I, maybe at one time dreamed of, maybe even being a junior Donald Trump or something. I don't know. So, but the glamour definitely was in commercial real estate and not necessarily in apartments or I didn't want to do residential real estate because I had no desire to work on the weekends. So that was the other, motivating factor to get into commercial.
All right. So over the next few years, how did you transition from just being a broker to actually owning one of these shopping centers?
I worked as a broker for about 2 years or so, and then I was offered a job from a large national syndicator. They were based out of Philadelphia. They had about 270 shopping centers nationwide. And so I started working with them as a leasing agent and eventually ended up handling the Midwest area for them, and not only doing leasing, but also redevelopment and, some other things for them. They, being a syndicator and based on the pre-Reagan tax changes, most of their stuff was not cash flowing properties. They were there was all kinds of crazy stuff because it was all about the tax write-offs. And so the majority of their properties didn't make any money. I had one shopping center, I think it was in Cahokia, Illinois. It was like way south, but it had 2 loans on it, and then it had a wrapped. So it had a total of, 4 loans, on top of, one shopping center that was a Kmart center in the middle of nowhere. So, but there was some crazy stuff going on back then.
When did you go from actually, I guess that's a great way to get started, right? You're learning how to be the operator, boots in the ground.
That's correct. I mean, I learned and I think I learned the most important part of shopping center investment, which is the leasing part, because all the income is really made on the leases. And and since the leases do last a long time, some of them up to 20 years, you could lock yourself into a really bad lease for a long time. Or you could, maximize the value of your shopping center, your individual triple net single tenant thing by doing a really great lease with a tenant. And so I learned it from that way. I learned all about income. I learned about how if you just get that extra $1 per square foot, how much it changes the value of the property. And then everything kind of crashed. It was the S&L crisis, the savings and loan crisis. And I decided with a partner to start our own company. So we formed Concordia Realty in 1990. We were doing workouts for banks, insurance companies, and real estate investment trusts. And then we gradually transitioned because our goal was to own actually real estate, but our experience was in shopping centers. So our goal was to own shopping centers, and that's how we kind of ended up where we're at today.
Oh, so what's the term for like the guy who's boots in the ground leasing up the stuff for you guys? Because that's a big key for you now, right? Like getting the right personnel, that person.
In certain markets, we'll use a leasing broker. So it's a real estate broker that is specific to that real estate market. In other situations, we use our own leasing representatives. So, for example, there are certain relationships that I have that I'm still involved with. So we're in the process of doing an Old Navy right now, and I have relationships with Gap and the Gap broker, because a lot of these guys have actual national brokers too. So it's a weird situation. But since I have those relationships, I'm the one that's, front in dealing with them, or go out to San Francisco and meet with them and say, we've got a few opportunities here. Would you guys like to do this? That type of thing. And then there's, since I've been in the business since 1980, I've met a lot of people that might have started out in one company with the retail leasing reps. So the retailers have their own real estate department. And so there's people that only do real estate for the retailers because their whole thing is all about expansion. And so I've had relationships with some people since, the mid 1980s, and they now are the heads of different departments, or they're, involved with different things. So I can call them up. And even, for example, a friend of mine is one of the main vice presidents of real estate at Dollar General. And so I can call him up and I can say, we're looking at a shopping center and it's got a Dollar General in it. Or I can also call him up and say, I'm looking at this shopping center. It's got a Dollar Tree or a Family Dollar. How do you think they do there? And, he can tell me basically what he thinks the market is, or he actually knows what the store sales are because they can track that stuff.
So those are where the more senior real estate brokers graduate to for more stability in their job than those types of positions.
It's really weird that most of the guys that start out on the real estate side, stick with, working with a retailer. And so the retailer, their real estate representatives don't make as much money as the real estate brokers, but the retailer representatives have a steady income. So it's, unless, a lot of times the retailers go out of business and then they've got to go get another job. So it's kind of a different mentality. And you don't usually see people moving from the retailer side of the equation to the landlord side of the equation. And it's a really weird situation. I don't know why that is. Every once in a while you do. And I think the guys that do move from the retailer side to the landlord side are much better leasing people because they understand how the retailer thinks a lot better than a guy that's only done the real estate side all his life.
Right. Sort of like how I'm just a government worker, want more quality of life, or like a Kaiser Permanente doctor. They just want stability.
Yeah. I mean, that's, you've got, but you're doing the great thing. You've got the base to work off of, and then you've got the extra, stuff that you're working on. So it's just icing on the cake, but you still got the base to work with. So
yeah, I
should have done
that. No, it's a kind of a silver handcuffs. It's not quite COVID. But let's kind of get into this shopping center thing, because when I first connected with you, I kind of thought what every other guy who is on the internet thinks is like, okay, Amazon is going to kill these shopping centers, right? People are just click a button, order it. The drone's going to come deliver it. And all these businesses are going to go out of, and they're just keep building these things. But I've kind of changed my mind, right? And, I think if you're, the saying is like, you want to be best in class in everything. There are a lot of mobile home parks out there, but if you can be the best one, you can attract the best tenants and the best terms, and you can be best of class.
Right.
I see the same thing here, but maybe let's talk about some of the obvious things that kind of come off the top of your head when you see people cringe on shopping centers.
I always point out that as of 2017, internet sales were still only about 10% of total sales. And at the end of 2018, I don't know what they are, but I don't expect them to be much more than 15% of total sales. I also point out to people that Amazon bought Whole Foods, and that was a $13.7 billion acquisition. They not only did that, but they're now opening up Amazon Go stores, and they intend to open up, I think they said they want to open up 3,000 to 5,000 stores within the next 5 years. That's a super aggressive rollout. So I don't know if they're going to be able to get that many, but I mean, they really have all the data points. So if somebody could do it, they could do it.
Right. Jeff Bezos believes that brick and mortar is the place he needs to get to and be.
And I also, you take a look at what Walmart and Kroger and some of the larger guys are doing. And to be a well-rounded retailer, you're going to want to go omni-channel versus just either straight online or, straight physical presence. But a really cool thing, like both Walmart and Kroger are competing against Blue Apron by, you can go online, you can order the ingredients, and then you can pick it up the same day at the Kroger store versus, kind of waiting for it to come in. I don't know. I'm not exactly sure how the complete Blue Apron thing sets up, but, they're trying to head off a lot of that, what some of those other guys are doing in terms of sales. The other stuff that I see is there's a lot of tenants that are that don't really aren't influenced by internet. So, for example, Ross stores, Ross and to a certain extent Dollar General, Family Dollar, and those guys cater to a lower income customer. A lot of those people either pay in cash or pay in debit cards, and they don't actually have credit cards. And so a lot of those people actually aren't using and doing things on the internet. So I think a lot of people that are in New York, Chicago, LA, San Francisco, or else in tech businesses are used to doing everything online. But there's this really wide array of people out there that don't do a whole lot of online. And then you've got places like the middle of Indiana where it's really expensive for Amazon to ship something because they don't have the footprint, versus if somebody actually goes online and wants to buy something from Walmart. I think Walmart, their most recent statistic is they have a store within, I think, 5 to 10 miles of 90% of the population in the United States. So if you're looking to, do an omni-channel presence, they've got it. The next thing that I explain to people is that the Wayfair versus South Dakota decision, which was all about collecting sales taxes, is dramatically going to impact a lot of retailers, because they're going to, even if they don't hit the threshold of selling 200 sales, or I forget what the dollar amount is, $100,000 in sales, they're still going to have to track all those sales just in case they go over. And so it's going to be an extra nightmare, and they're not going to have the flexibility to say, oh, you don't have to pay sales taxes anymore. And
that's
Amazon,
the one where, like, a headquarters is in a location, then they got to collect, or if you live in that state with the headquarters or any physical presence.
The new ruling that just came out this year, any state in the country, if you're selling into it, you're automatically required to collect sales taxes. Now, like I say, the Supreme Court had certain threshold limits, so they limited it to you have to sell over 200 transactions per year, and but for the most part, it means that all people selling on the internet into the United States, into an individual state that has a sales tax, has to, start collecting sales taxes. Yeah. So that's going to be a big issue. And then, shipping is, a big issue. So you make more money selling in a physical store than you do online. There's less returns.
All right. I like that statistic of only 10% are buying it online.
Yeah, and just to address, I think the biggest thing is that the news media equates all the tenant bankruptcies with online, but most of the tenant bankruptcies are really about financial structuring. So the most recent one, Sears. Sears didn't have a reason to be in business for the last 20 years. I mean, Sears really should have, when, they keep saying Eddie Lambert is this genius, but as soon as he bought a giant position in Sears back, I think 15 years ago or so, he should have just started closing down stores left and right and redeveloping them, as high-end retail, because he would have made a ton more money, and he could have wound down. He could have sold off the Sears Die Hard brand and the Sears, I forget what the tools are called, but in Kenmore, he could have sold off all that stuff, and just, the thing was more valuable for the parts. And then we go to Toys R Us. Toys R Us was losing sales volume to Walmart and Target way more than they were losing sales volume to online retailers. And Toys R Us couldn't compete because they had gone through a few leverage buyouts. And so they had all this debt that they were trying to service. And so they weren't putting any money into an internet strategy. And they certainly weren't putting any money into, their stores. And so instead of being a place where people could go and have a great experience and say, oh, I want to go there with my kids and I want to buy this stuff and they've got a wide selection. You go in there and there's a bunch of screaming kids and there's stuff all over the place. And there's like, young guys, or young women working there that don't care. And it's like, well, do I really want to go here? Or can I just go get this, stuff as long as I'm at Walmart or Target?
Yeah. It looks like the guests are with all this crap all over the place.
Right. So that was, the main reason why, Toys R Us is no longer in business. And then we can go to department stores. There's really no reason to go to a department store anymore because, that all started kind of hollowing out because there's specialty stores, and so if you're going to go get in, not that, department stores ever carried that stuff, but if you're going to go to, a pet store, you're going to go to PetSmart, or you're going to go to Petco, or you're going to go to one of these places, or you're going to order some of the stuff online. But
right, you try it on and see what size fits you best, and then go on.
Right. So I think we're going to see the disappearance of most department stores. I think that Nordstrom really has it together so far. So I think Nordstrom will be around.
The high end, but the middle is disappearing.
Yeah. Well, that's the biggest issue. That's the other thing is retail is really bifurcated now. And so it's either low end or high end. And so if you're anywhere in the middle and you're catering like Kohl's, I think Kohl's is going to have a real problem. I'm not sure that Kohl's is going to be around, for a long time. They might turn it around, but, if you're a dollar store, you're Aldi, you're a discount grocery store, or, you've got, some sort of specialty food store in the grocery, or you're a Whole Foods, you're doing very well. If you're just catering to the general masses, you've got to do something to differentiate yourself.
Right. I mean, the high end will be fine, like the Nordstroms, the Bloomingdales. But
I believe so. I think even the high end specialty stores. Like I was just out in California, and Fashion Island, or some of the other malls out there. They're just doing gangbusters, and it's because all they have to do is sell like one or two shoes. Like Jimmy Choo. Jimmy Choo's shoes are like $5,000. All they have to do is sell like one or two, per day, and the margin on that is like incredible. There's like it can't cost more than $100 to make one of those shoes, but they're selling it for $5,000.
Yeah, this Jimmy Choo gets a lot of money. I don't know who that is, but I think they're saying like Macy's, like they rely on all these stupid sales, right, and these coupons and
right. Which was the same problem with JCPenney. It's the same problem with Sears. I mean, they've trained their customers to come in only during a sale. So it's an issue.
All right.
And, instead of being everyday promotional.
Right. So we've kind of bashed shopping malls. I guess let's differentiate, right? Shopping malls are like kind of the more big box ones, where the shopping centers are the ones that we're looking to.
I'll differentiate it. A shopping mall is typically an enclosed shopping center, so it typically has a roof, it has air conditioning, and there's the parking lot on the completely around the shopping center, and then the stores, and it's typically got department stores, and so that's a shopping mall. Every once in a while there's open air shopping malls. You'll see those out like in California or some other places, or there's one, in the town that our offices are in. Oak Brook Shopping Center isn't open, but normally you don't see that in a place where there's snow. And then there's what we call strip centers, which is the open air centers, which has the parking in the front, and people park, and then you can walk into the store in the front. And so that's the differentiation. You've either got a strip center or you've got a mall. And then you've got a few hybrid things, like you've got, there's a, I'm trying to remember what the name of them are now. I'm blanking on it, but there's different things where village center type of a thing where they've got mall specialty stores, but no department stores. And those are typically outside. And so there's,
yeah, what would you call those? Like, they've got Best Buy.
That would be a power center if it's got like a bunch of anchor tenants in it. So if it's got like a Best Buy, a PetSmart, and what we call category killer tenants, that would be more along the lines of what would be called a power center. And then a smaller center with like a 7-Eleven would be called a convenience center. A grocery anchored center would be more what's called a neighborhood shopping center. And then if you've got like a Walmart or a Target and a grocery store, that would be called a community center. And then you get up into a regional shopping center where like a regional mall should draw from at least 5 miles, and some of them draw, from around 10 miles, and you just draw a radius around, and that's the population. So it can be, I'm sorry.
The regional malls would be no-go, in your opinion, for a mom and pop investor?
A regional mall is something that you have to have an insane amount of experience. So so you've got most of the regional mall owners are publicly traded. There's a few guys that are buying other regional malls, but the largest regional mall owner is Simon Properties. They're publicly traded. The best regional mall developer and owner is Taubman Properties. They're publicly traded. That's Alfred Taubman, who started that. And then there's also a few regional ones like CBL and some other ones. CBL is in trouble right now because they're all middle market malls and they're smaller malls, versus Simon has some big things. And the other one that was just bought up, Brookfield, which is a company out of Canada, bought General Growth Properties. And so General Growth Properties was the second largest mall company, and Brookfield Asset Management just bought them. And so General Growth has, Mauna Loa out there?
Pretty big one.
Yeah, and General Growth also owns Oak Brook Shopping Center here, which is like a 1 million square foot plus mall. Taubman Centers owns in this area, or Taubman Centers owns the Beverly Center, which is just a dynamic shopping center. And they also own here Woodfield Shopping Center. And Woodfield has a trade area of probably close to 4 states, because it's the second highest tourist destination in the state of Illinois. And it's drawing people because there are no Nordstroms, there are no, some of the higher end stores in some of these other states like Iowa, Indiana, and Wisconsin. So it's pulling people. And then if people, come here, they'll go out there, because that's like a 2.5 million square foot mall. So that's probably a no-go for your average investor starting out.
Yeah. So where should the sophisticated mom and pop investor go? Is it just that neighborhood?
I would say that the neighborhood or the convenience. I have some issues with the convenience shopping center, because if it's an unanchored shopping center, you're ending up competing more on price with rent than you are with some sort of, tenant mix, versus if you go with a grocery anchored center or a community center which has like a Walmart and stuff, you can also, you're competing on, hey, I've put together a good tenant mix here. And so it's a destination. People are coming here, so you can afford to pay a little more money.
So it's kind of like get away from like the low end stuff. Like, don't buy D-class rentals. Just get a little bit better than the bottom, and now you can compete for better tenants.
To a certain extent, but I would actually go with, like a convenience center that's anchored by a dollar store, because there's a draw. versus if you just have a convenience. Like, for example, there's a lot of stuff for sale right now in Las Vegas, and they want an insane amount of money per square foot for it. And the anchor tenants are like a mobile phone place, a vape shop, and a smoke shop, and then, like some little local casino. And, they want you to pay like $300 a foot for it. It's like, no, I don't think this makes sense. So versus I can buy a, pretty well anchored shopping center in certain parts of the country. Like we're looking at a deal in Reno, Nevada, and we're looking at buying a grocery anchored shopping center, which is around 280,000 square feet. And that's, $100 per square foot. So do I want to buy a crazy shopping center in Las Vegas that, the main tenant is a smoke shop and a bake shop? Or do I want to buy a grocery anchored center that, has a combination of pretty good tenants in it for $100 a foot?
Yeah. So when you buy it, you obviously want to buy it with value add, but do you buy it with that anchor tenant in place, or is that what you're bringing in?
If there is no, on the one that we're looking at in Reno, it has an anchor tenant in place, but it also has a 50,000 square foot vacant anchor. So that's why it's available for a less expensive price. But there's certain places like we're looking at deals down in Indiana. There's another one in Michigan and another one in Cleveland where you can buy a grocery anchored center where there's not a bunch of, stuff to do except for, leasing up a few vacants. And you can get those for, around $100 per square foot. And we prefer to buy below replacement cost. And so right now, in most parts of the United States, it's at least 100 to 125 per square foot to build a new shopping center. And in most metro markets, it's up above $150 a square foot to buy, to build a shopping center. So if you can get a well-located piece of property and you can be in the $100 per square foot or below, or in a major metro area, if you can buy it at $120 to $150 per square foot, we think that's more of what we're looking for versus cap rates.
Right. What are like the rental rent per square foot? What are the typical averages there are?
It's really hard to say because it's really depending on what type of shopping center it is and also what the population around it is. So we have a shopping center right outside of Chicago that has really extreme population densities, and on the smaller shop space we can get up to $40 per square foot. And on the larger junior anchor tenants, and that's with everything. So that's real estate taxes, rent, common area maintenance. So the tenant is probably paying close to $30 or actually $30 per square foot, and the extra charges are around $10 per square foot in that particular location. And then you can go outside to like, Indiana, like Indianapolis or Cleveland or some of those places. And your average rent, might be somewhere in the $8 to $10 to $12 per square foot. So it really depends on the income surrounding the area and also the population density.
Yeah, so that's about 10 times what, way more than 10 times what you'd be getting with residential real estate. I think a lot of our stuff is like hovering around 80 cents to $1 a square foot.
Yeah, well, and then certain, like the malls, like if you get a really good mall, like Mauna Loa Mall, if you get small shop space in there, some of those tenants are paying more than $200 to $300 per square foot.
Yeah.
And on New York's Fifth Avenue, there's tenants that are paying up above $1,000 a foot. So it's just a matter of how much business they can do.
And now explain to me, like a lot of like the reason you go commercial retail is that not as opposed to residential real estate where you've got a tenant there, they're just paying and they can just often leave. you sort of get collateral on your commercial tenants, right? Maybe explain how that works.
You don't necessarily have I mean, we do get personal guarantees from, the local tenants. And we do work with publicly traded companies. So the last thing, McDonald's is going to do is have a late payment, because that's really going to affect their stock price. So I can tell you that McDonald's, Walgreens, Ross, TJ Maxx, and those guys, they're sending in ACH payments, and you're getting the rent, 3 to 5 days before it's, the first of the month, and it's like clockwork. Now, they will argue with you about what's called common area charges, and they'll come back and say, well, you're billing us too much for this, and there's that kind of thing. So that's a management headache. But you're never going to worry about getting the rent unless the tenant is in financial problems. And there's a lot of, I should say, there's some pretty huge warning signs whether a tenant's going to file for bankruptcy or not. At least a year before that they're going to file. And then if they do skip a rent payment, that means they're definitely filing, because they don't have to pay pre-petition rent. So you typically skip 1 or 2 months.
So a lot of these, when you lease these guys up, are they on that triple net lease thing?
We all are. So one of the value add strategies is we like to find, but you don't find them that much anymore, shopping centers that are on what's called gross leases. And so that means the tenant just pays one check and they don't pay their share of real estate taxes or common area maintenance. And if those leases are short-term leases, then as they roll over, we can switch them out and convert them to a triple net lease. And that protects the income stream for the landlord, because if the real estate taxes or the expenses go up, the tenant's paying for those. And so the landlord isn't getting hit by, if the electricity costs go up, or, in residential real estate, the gas prices for, heating the place goes up. So that's one of the things we like about retail real estate is that when you do the lease, you're pretty much, if you do a triple net lease, you kind of know what your upside is, but you also know what your downside is, that it's not going to eat into it.
And both parties want that, the tenant and the landlord, they both kind of want that stability.
The tenant wants it because the tenant wants a little bit of control over, what they have, and the tenant, then the tenant doesn't have to hassle with it. But the other reason why the tenant, will pay into common area maintenance is that they want the entire shopping center looking nice. So McDonald's doesn't want, to be in a shopping center where they're paying to pick up their area, the parking lot, but the rest of it, or this is the big thing in the northern climates, is you want the entire parking lot plowed. Because if McDonald's or Walgreens or some other tenant is out on the out parcel, you normally have to go through, the entrances to get into those particular stores. So you want the entire parking lot plowed so that, your customers can get to you.
Makes sense. So one fallacy I think that I see some investors looking at is they want to have a shopping mall that's all triple net, right? Because they hear about it all the time. Oh, did you hear about this triple net? It's like turnkey, right? Turnkey commercial real estate.
Right.
But in actuality, there's no value add in there, right? So you're buying sort of like a turnkey rental, and the only place for that thing to go is now you lose your turnkey tenants.
Well, you also have to be careful, because it's best exemplified by single tenant triple net leases. So you could be buying let's say a Dollar General, and they'll say, oh, it's a full triple net. Well, on a lot of those leases, you still have the landlord has to maintain the structure and the roof. And sometimes the landlord has to, replace if the HVAC goes. So you need to, clarify that it is full, completely triple net, and the tenant is also paying for this. Because in a shopping center, the tenants don't pay for their roof. The tenants don't pay for the replacement of the HVAC. They have to maintain the HVAC, and they have to like have a maintenance contract on it. But if your main compressor goes out on your air conditioner, the tenants, typically the leases are written that the landlord has to pay for that. So it's not full, completely triple net. The one place where you will get that is in a ground lease. So a ground lease, the tenant actually builds their store, they maintain their store, they maintain everything, and they just send you a lease. Ground leases, they typically pay less. So if I was a developer and I built the store for the tenant, I would be adding in the cost of building it, and then I would be adding in, like an 11 to 12% return on my cost for that. And so I would be getting not only lease for the ground, but I'd also be getting an extra additional rent for the building. So those end up being worth more. But if you're looking for complete hassle-free, a ground lease is the way to go, but it's basically like buying a bond. There isn't going to be a tremendous amount of upside. The upside would be if there's cap rate compression. So if you bought something that was in the path of growth, and like, let's go, for example, a Walgreens, and you paid a 6%, and then all of a sudden path of growth comes out, and it's like, oh, this is like high density area. The cap rate might go down to like 5% or 4.5%. So, but that also all depends on interest rates.
Right. I mean, I think people, they look for these low risk investments like performing notes.
Right.
It's like, yeah, you're not really making much on that. You might as well go buy a savings bond. Right. Most things are sort of risk adjusted.
Yeah, I think you're making a little more than a savings bond. So it's probably better than but you also could theoretically take your money out of a bank at any time. So I look at it more like getting a higher paying CD. So, because you're in it and then there's transaction costs.
Right. I mean, how are the cap rates in shopping centers compared to with like other asset classes like apartments, single family, mobile home parks?
I don't know. I can tell you how they compare to apartments, and I can tell you how they compare to, industrial and office buildings. I don't know what cap rates are for mobile home parks, but cap rates right now for well-located, grocery-anchored shopping centers are anywhere from 6%, and they've been going up to around 7 to 7.5%. And we've seen in certain markets, stuff not trading, and so it's kicking up to around 8%. And then we've seen some slightly distressed deals that we think we could fix for around 10%. And then if it's a straight triple net lease with a real what we call bond quality tenant, that would be if you were doing a triple net lease with a Walmart or a Kroger or a Walgreens,
a Starbucks, or
a Starbucks that was company owned. Those things can go for I've seen them in California as low as 4.5 cap. But typically the cap rates have been inching up, and your average cap rate on the single tenant triple nets are probably somewhere right now in the 6% range.
And where like just a strong company like a Family Dollar, but in a little rougher class of a neighborhood, that would be like a half a point higher then,
or a little bit higher than that. Yeah. So if it's a rough neighborhood, there's a risk adjustment for just where it is, because you're not going to get any appreciation on it. So if I bought a Family Dollar on the south side of Chicago, I'm expecting that I'm not going to get a huge amount of appreciation. So I better be just getting a pretty good return on my investment straight out, and hope that I'm going to get my capital back and make a return on it.
Right. And the cap rates is just one half of it. The other half is the interest. What kind of debt are you able to put on these things? Is there any Fannie Mae, Freddie Mac products, or?
No, the debt is typically amortized over 25. You don't usually see 30-year amortizations. And then the debt normally only so the term is only about 10 years. So you're seeing 5, 7, or 10-year debt. You typically won't see a fully amortizing loan on a piece of commercial real estate. A lot of the debt is CMBS debt, which is commercial mortgage-backed securities, or we just did a $18 million loan with State Farm on a 300,000 square foot community shopping center.
All those insurance companies are better than.
Oh yeah, that was the interest rate on, it's a 10-year loan. And the interest rate on that loan was 3.8%, and it's amortized over 25 years, with the first year interest only, because we had we were replacing an anchor tenant.
Are these non-recourse for you guys?
Well, I've only in the past 25 years, I've only done one fully non-recourse loan. And that was because the loan to value was like 35%. And so there's always in commercial real estate going to be what they call carve-outs for the bad boy clauses. So if you commit fraud, if there's environmental issues, what's the other one? If you commit waste, so if you don't take care of the property or you deliberately, then there'll be, personal recourse. But other than that, if stuff just doesn't go right and you do everything that you're supposed to do according to the loan, there is no recourse. You can just mail back the keys. So,
and that's a component of the CMBS loan or the insurance company. They'll write that in.
Yeah, but most commercial loans, they're going to have some sort of, as I said, bad boy carve-outs for recourse, but they're, for all intents and purposes, as long as you don't like deliberately commit fraud and steal things, or you don't do things that you're supposed to, or unfortunately, if there's a environmental problem, they will come after you for the full amount.
Right. So what do you think of you mentioned you've worked with institutional investors in the past. I work with a lot of private equity. How is it different than working with regular people, working with these bigger players? Some feedback I've heard is that the institutions, they want a lot of control in your operation. Is that what you're seeing on your end?
Well, that's the main issue. Number one, you're dealing with really sophisticated investors, so they know, broadly speaking, all about real estate investment. And some of these guys are like what I call rocket scientists in terms of financing. So they really know how to structure finance like you wouldn't believe. They're not as deep into the operations part of it, but from a general level thing, they can take a look, and we will present a business plan. They'll say, well, what about this, and this, and why didn't you do this, or how about this guy over here? And so they're actually involved to a much larger amount of control. They'll also, as part of the joint venture agreement, if they're putting money into it, they have the right to replace you. So if things aren't going well, they can come in and say, we're going to boot you out, and we're going to put somebody else in because you're not executing on the plan. And then the other issue is a lot of them are not long-term holders. They want to be in, and in 3 years be out, because especially a lot of the private equity funds, they're raising money in 5-year spans. And so by the time they get to your investment, they've already been raising money for about a year. And so they want to be out of your deal in 3 years so that they can close their fund at the end of 5 years.
Oh, so what are you thinking in terms of like markets? Do you like primary, secondary, or tertiary? It does not matter, I guess. Is it more asset class?
We're more opportunistic, but I really do like tertiary markets a lot better. I think some of the primary markets are really super overvalued right now. So I think there's much better deals in in other, smaller markets. For example, we are looking at a few deals in Indianapolis. We actually just wrote an offer on a deal in Indianapolis, and it's a Kroger anchored center, and it's what was it, $82 per square foot. It's in a great area. It's just that Indianapolis isn't really valued as highly. And then we're looking at a deal in Phoenix, Arizona, and that's a Fry's anchored shopping center, which is owned by Kroger's. And that one is close to $180 a foot.
Wow.
So, but you've got a higher income in Phoenix, and you've got higher density surrounding that shopping center in Phoenix. Plus, the other thing is you've got a lot more investors coming in from California, and California prices are just like crazy.
Yeah. I mean, I'm looking here, and I'm always trying to find something other than an apartment. I'm kind of an apartment operator refugee, and I'm looking at assisted living, and retail shopping is another one, just because it seems like I can just find a good broker and they kind of manage things for me. They've got all the value add or things that I can kind of oversee and have management oversight on. I don't know why I'm thinking of assisted living. That seems like the opposite end of the management headache spectrum.
Well, but if you've got somebody that's managing it, I can see why. I don't know a whole lot about it, but it certainly is a super huge growth market. I mean, the amount of people that are going to have already retired and are retiring, that are my age. I'm the last, year of the baby boom. And over the next few years, there's just like this giant amount of people retiring. So that's just going to be a super growth market if you can get the right operator in it. But I think it's all about operations. And I would say it's the same thing with, retail. You have to know a little bit about merchandising a shopping center and what a good location is, which I think is all, you can figure out, but you still, need somebody to execute a little bit on it. And then, once you get some experience in it, I think it'll be, it's something that people can figure out. Versus, I don't know much about mobile home parks, but self-storage, mobile home, and apartments seem pretty easy to get into because everybody kind of lives in a home, so they kind of know what a house needs. And self-storage, it's like, well, it's a mini warehouse, and people come up, and I think that's all about marketing it. And so I think those are something that the average investor can get their mind around. Versus once you get into specialty commercial real estate, like offices, like, shopping centers, or as you say, the assisted living or anything to do with, healthcare.
Right. I mean, shopping malls are kind of appealing because they're everywhere. I mean, I've looked at stuff here in Hawaii, and unfortunately, I think it's just a primary market plus here. You've got these smaller, like grocery anchored centers, and it's owned by like an international group. So I don't know if that's a trend. That's a trend here that, just international groups, they just want to launder their money at 2% a year. It seems. Well,
like it's really tough because Hawaii is tough to get into. It's kind of like buying a shopping center in Florida, because I'm not making a racial statement, but you've got all these Jewish guys from New York that were all like super huge, real estate operators, and all of them want, to retire down in Florida. So every time they go down to Florida, they look like, oh, I could buy a shopping center here, and then I can just expense it.
Like all the Indianapolis guys are like, oh, these idiot California and Hawaii investors are like buying stuff here. We can't.
Right, because, the California and Hawaiian guys are selling stuff, at a 3 cap and a 4 cap, and you can buy, something in Indianapolis for, a 7 or a 10 cap, and still have money left over.
Right. Hopefully a lot of them just go to Vegas because they think they're going to get rich with the Raiders.
We really like the Vegas market, and we had a deal there, a few years back, and I was just talking to a broker that we've done business with. He's out of Phoenix, but he also does stuff in Vegas, and I had asked him about a property that he was marketing, and again, it was like this, not really well anchored shopping center, and it was like $230 a foot. And I just said, that's a little too pricey for me. I said, I really should have bought something, I should have bought everything I saw like, 5 to 6 years ago. And he just replies back, we all should have.
Yeah. What do you think about these, I'm looking at these secondary market office space buildings. Like think of like office space and, places where if you live out in the suburbs, instead of driving an hour and a half to this big city, you go to like Scranton, Pennsylvania, and you get 20 minutes to the local Class A office building.
I personally wouldn't get involved with it. I've owned office buildings. In office buildings, you're competing solely on price, and you have to have certain amenities. When the tenants turn over, you end up putting in tenant improvement allowance. You end up putting tenant improvement allowance in retail too, but you don't have as many national tenants.
It's more of a commodity then, as opposed to like all this other stuff we try and do. It's more of a fragmented market, so you can kind of.
It is. You're doing a lot of one-off deals versus if you have a relationship with in retail. I can call up the guy from Gap, whether I've got a shopping center here in Chicago or whether I've got one in Texas or whether I've got one in California, and say, are you interested in these? Versus buying something in Scranton, Pennsylvania, which I wouldn't do that anyways because of the growth. If I was looking to buy in a tertiary market for office space, I would actually look at Las Vegas. You could get some pretty good, per square foot prices in Las Vegas on office buildings. And it's a growth market. There's a lot of people like leaving California and relocating. And I think one of the plays, I'm not the guy to do it, but you should just set up like, one of those companies like they have in Delaware where they just, are the office space for all the corporations, And so like, because there's a few buildings in, Delaware, because Delaware is like a good place to. And so it's like there's like 1,000 to 5,000 corporations all domiciled in that one building, So, and you could do that in Las Vegas for all the people trying to escape California.
So what's something that me as the apartment refugee should try and do if I wanted to get into the retail shopping space? I mean, is there like a boot camp to go to? Do I just have to like come and find you one of these days and just buy your lunch and dinner and breakfast for a day and just like pick your brain? Or what's someone like I should do?
I think one of the things you could do is decide what market you want to go into and learn the market and develop a relationship with not only a leasing broker, but also a sales broker. So if I were you, I'd say, well, I'm going to concentrate. I really like Phoenix or I really like San Antonio. And I'm going to learn everything about that because you have to learn how a market operates first. So you need to know what trade areas are, which is, what shopping centers are in what area, and you need to know what the competition is. And then once you get that basic, understanding of that, then you can pretty much take that anywhere in the country. Like I can, I was just talking to somebody the other day and they're like, well, how do you know about all these different markets? I'm like, well, I can parachute into like Reno, Nevada and know everything there is to know about the trade area within half a day, because I can tell you where, just I look on Google where all the major, intersections are, and then I just drive them, and then, I can figure out the rest of it because I have that experience. So, and you can get that experience just by learning a little bit about that. I would also recommend they have, different deals that come through from, either syndicators or on the crowdfunding websites. I think the crowdfunding websites, I haven't been impressed with the shopping centers on there, and I've actually talked with a few individual investors that have been interested in investing with me. And we've gone through a few deals on the crowdfunding websites just so I could show them what to look for and what not to look for. But the nice thing about the crowdfunding websites is they do have the videos and they have the stuff that you can take a look at. And so I think it's an educational, once they do like a webinar on what they're looking at. Another good webinar that I saw, you might know him, Eric Tate.
Yeah.
Doctor. Yeah. He just did a syndication on a property down in Houston, and he put together a really nice webinar that's very informative, just as a general overview of that particular investment, but how you would look at investing in a shopping center total.
So if you weren't investing in shopping centers and you're just being an LP, what would you be? What asset class would you look keen on these days?
I do like the apartment story, just because, I think there's still room to run. It's really scary. I think that apartments are way overpriced. I don't know when the correction's coming, but if I was doing apartments, I'd go into some of the smaller tertiary markets, and take a look at those.
All right. Well, I think kind of wrapping up here, Michael, just kind of to close out, like my opinion on these things is, at first, I thought Amazon was going to come and kill the shopping center. But now that I think about it, in my strange lifestyle where I typically don't leave my house and, I just go to work, I just stay in this like 2 to 1 mile radius of my house where my gym is at. I mean, I do go to these neighborhood shopping malls quite often, go to the grocery store, go to get something to eat, go to the doctor's office here. And I do see like, I would use them. I would stay away from like the big shopping malls, like it's like the bubonic plague or something like that.
Yeah. No, I agree with you. I agree with you. Like, cause a lot of the middle market malls are going to be like scraped. I mean, we did operate 3 malls in our experience, and in 2 of those malls, we ended up emptying them out and demolishing them and building something else. So that's, kind of my opinion of an enclosed mall, unless it's a really good mall. And then you bring up a good point. Shopping centers are also kind of like community meeting places. So if you've got like food in there, if you've got like places where people could sit, or you go and like hang out, or that's what retailing does. We've added in some of our shopping centers artwork so that it draws it's like a little bit of a difference. And so especially if it's interesting to kids, parents will bring their kids there and say, oh, you want to go see the ball machine, and then they'll bring them to that shopping center versus the shopping center across the street, because it'll give the kids something to do, or it's an attraction. Or on a few of the shopping centers, we've added wind turbines, even though they don't really do anything in terms of generating electricity. They're kind of like kinetic, and their artwork, and people say, oh, you guys are doing something. That's great that you put the wind turbines up there. So
yeah, I mean, if there's anything I learned from a couple of years being a city engineers, I think the old school way of designing cities is like where you got like this grid system where it's all like that. Now it's sort of like a few streets and it goes to like a main street, but then it goes to your community shopping center. And then, just in general, people will see it on their main arterial coming into town off the freeway. You might have 2 to 3 lanes. Now those 2 to 3 lanes, instead of like 12, 13-foot lanes, now they're 11 and a half. They're smaller, and there's a little bit more trees in there. They probably put the bike lane in there just to get the cars from going. The speed limit's still 35, but people go 45, 50 on those things. But now They're trying to get it lower to get more of that neighborhood feel. And then the smaller shopping centers are kind of also part of all that.
Well, you should come out and visit me, because I live in Riverside, which was the first planned community in the United States. It was designed by Frederick Law Olmsted. So when you come out, I could take you for a tour, and we could, give you a little bit of a mentorship on retail real estate investing.
Yeah. Yeah.
Don't come in the wintertime, though.
All right, Michael, what's your contact or your website to if people get a hold of you? And
My website, or our website, is concordiarealty.com. That's CONCORDIARELTY.com. And if they want to get a hold of us, they can send an email to info at concordiarealty.com.
or you just look up Michael Flight. It's spelled like how you think it is. He's Googleable, so.
Oh yeah, you can look up Michael and then Flight, FLIGHT. So.
All right. Well, thanks for coming on, Michael. Well,
thank you very much for inviting me, Lane. I appreciate it.
All right. Take it easy. All right. Hey, Simple Passive Cash Flow listeners. I'm very excited to be announcing our very first Hui Investor Tour. I'm taking you guys out to Atlanta, Birmingham, and Huntsville. Check out some properties, meet some people I work with, and for the most part, just get you guys comfortable with the Class B and C locations out there. I think a lot of you guys are going to be pleasantly surprised in what you get for $100,000 out there that can rent for potentially $1,000. So it's be taking place on July 21st to the 24th, 2019. And I think one of the biggest draws is you guys get to connect with some of the other people out there. So check out the info page here. We've got some early bird pricing. It's going to be, the price will likely be going up. One of the big reasons I'm doing this is because, some feedback I've been getting is, I've sent some people up to kind of connect with my folks, and then they come back and they're like, oh, wow, that really makes me feel a lot better. And I was able to build a lot of personal relationships with property managers and get a sense of the neighborhoods up there. And now I don't got to go back because I don't want to go back to Birmingham because it's a little boring. So some of what you'll see is, we'll take some tours of some properties, some of my properties. We'll even check out some apartments, and we'll meet some people. We'll have some dinners together as a group. So that's the big thing about building relationships with other serious and passive investors. The itinerary will be on Sunday. We'll be arriving into Atlanta. You guys are in charge of your own flights because you guys are grown-ups. We'll kind of rally up in the evening. That'll be the travel day. So rally up in the evening at the hotel. I'll have a little program for you guys. We'll kind of do a little mixer. We're trying to incorporate a lot of fun into this. But the next day, Monday, it's our early rise and shine. We'll be heading out to some properties and meeting a bunch of people. And then we'll try and do a little bit of fun tourist activity, maybe either on the Beltline, which is the old converted railroad tracks it's kind of a big linear park, upscale park that goes around the city, or we'll do something in Decatur, which is on the east side of Atlanta, which is where a lot of my rental properties are, and you'll see a lot of the gentrification out there. Also on the next day, on Tuesday, we'll be heading out as a group to Birmingham and kind of be doing the same thing there. Birmingham's not as fun, but we'll have some barbecue out there, and then we'll do another evening workshop at the hotel. Hotel arrangements will be all we'll try and make it all at the same site. You guys are in charge of your own hotel, but we'll make sure that we'll all kind of stick together. It's a lot safer and it's a lot more fun, and it gives you guys an opportunity to connect with each other. On the fourth day, Wednesday, the plan is you guys are going to go out to, you guys can choose your own adventure. You guys can come with me to check out my deals in Huntsville, check out the location, or if you guys just want to go out and break out, there's a Kansas City and Braves game at 7:30 where you can go see that mythical panda at the zoo. So, that's one of the things why I like investing in real estate. It gives me an excuse to go out to places I wouldn't and, do some tourist activities and be able to write it off as a business expense since I'm out there doing business most of the day. So it's going to be a very fast-paced, fun trip. The idea is get you guys in there, get you guys acclimated with the location, get you familiar. We've got a lot of special guests, a lot of the people I trust, and they'll be dropping their knowledge on you guys, helping you guys out. It'll be sort of like a boot camp style. You guys can be able to ask me any questions. I'll be with you guys the whole time. And make sure you guys hurry up. And our pricing is going to be going up after the early bird special. It's going to be a little bit of price break if you guys want to bring your spouse.
again, you guys are on your own for your guys' hotel and food costs, and we'll try and figure out a way to split up the transportation once we get a finalized head count at this point. Mastermind members, if you guys haven't heard about that, simplepassivecashflow.com/journey, you guys will be getting a 30% discount. Some of the frequently asked questions here, we talked about the hotel. We'll be trying to get a block of rooms all in the same place, just mostly again for safety reasons. But I want to make the tour very flexible for you guys. So if you guys can only make it on like 1 or 2 days, that's better than nothing. And you guys will, you guys be into the whole program of meeting the folks and seeing the right things. But if you just want to dig out and go to a Braves game, that's totally fine with me. We're going to try and keep the group size a little small, 8 to 15 people, enough to fit in a van and a few cars, just so everybody gets to meet each other. I always try and keep it a more of an intimate environment, kind of conducive to networking. And I personally would fly out of Atlanta the day before or day after. Or if you want to turn it into a vacation and go to Orlando and go to Disney World, that's up to you. But if you guys have any more questions, don't be afraid to email me, Lane at simplepassivecashflow.com. Check out the website, simplepassivecashflow.com/tour 2019. And I hope to see you there in June 21st in Atlanta. Bye.